a Bitcoin has a legitimate non-fungible entry in a blockchain that says it and only it represents that thing. And I think that is I guess the link.
Security interest.
Some may call it tenuous, but I mean, I tend to think at this point, Bitcoin probably has to be regulated like a security, even if it is not, and it's more of a commodity, only because of the volume and the sheer size of both the market and the
potential fallout is the way you're saying it, right? The potential fallout when things go off the rails is so great, you kind of need to have some rails.
Yeah, I mean, like again, as I've said, like, look, if you're a market participant trying to trade, very sophisticated, derivatives of any kind, for example, in the credit markets, we have to go and we create these things called ISDAs. They're called ISDAs, and it's basically a kind of an account that allows us to go and, take risk in some of these very esoteric markets. But the underlying principle around that is a common set of parameters, a clearinghouse, the ability to monitor risk. None of those things exist here. And I think that's really what folks have to solve for now. Secondarily is, what were all these kind of like shadow activities? It seemed too good to be true when you would hear, wow, this DeFi protocol will yield you 24%. And you're just like,
who was paying the 24%?
It never made sense, really, but then none of us really questioned it enough.
I had people on This Week in Startups, I questioned it all the time, and they could never explain it to me. And then now the explanation was, well, we were giving short-term loans to other people who basically wanted a margin loan. They want to hodl their Bitcoin, but that was only 4 or 5%. What they were also doing was giving you tokens in some other cryptocurrencies that they were basically originating. So they basically were like, we'll give you 4% on your Bitcoin loan. Somebody else will pay that. You'll pay that. But then the other 11% is coming from some tokens we're giving you that actually, have to, airline miles.
We have to answer
giving you airline miles.
We have to answer a really important question. Look, the markets have incinerated many trillions of dollars. I just saw, like, for example, there was 1.7 trillion, that was just torched in ETFs alone, just since the beginning of this year, right? We've done that or more in the crypto side. We've done that or more on public equities, right? We're probably going to do that or more in other markets. But every other market is regulated, and there's a full accounting of the P&Ls on the dollars that are won and the dollars that are lost. And here, some folks have just, basically escaped with billions and billions and billions of dollars. And the bag holder is just, a retail investor. So the real question is, are regulators going to actually care to try to do something? Because the level of grift that's happened in this market is extreme. And especially when everybody was telling you, no, this time is different. This market is completely different. It's transparent. It's on chain. You can see and it turns out actually most of it was not on chain. It was off chain.
And
Crazy.
they were using this, hey, have fun being poor, this like psyops to get you to participate. Okay, boomer, you don't get it. Gensler was talking to Kramer on CNBC. Here's the quote. Some, like Bitcoin, and that's the only one, Jim, I'm going to say, because I'm not going to talk about any of these tokens that my predecessors and others have said are a commodity. And then he said, many of these crypto financial assets have the key attributes of a security. Aside from Bitcoin, he believes, like these things are securities. And that makes sense because 99% of people buying them, Sachs, were buying them because they wanted to see them appreciate. They were never using these as utility tokens. They were buying them to, see them appreciate and to flip them. So what do you think, Sachs? Is there, when we look back on this whole mess in 10 years, is it going to be like the dot-com era where we're like, yeah, it got overheated, but Amazon and Google came out of it? Or are we going to look at it and go, well, that was tulip season?
Well, I think there is a future technology platform here with crypto. But I've been saying this for the last year, that just because there's a future technology platform doesn't tell you what the pricing should be. And the price action got decoupled from the level of progress in the space. You should always be looking at what is the real usage, use cases, customers, revenue, things like that. And people stopped doing that. And I think part of the reason why the narrative was so powerful, if you go back to last year and the chart that Chamath showed about the increase in the price of Bitcoin, which is really the root of everything, right? Because, first Bitcoin appreciates. And then if you think about it, like Ethereum's market cap is like a derivative of the Bitcoin market cap. It's been roughly 40%. And then the altcoins sort of get the market cap of the altcoins is sort of derivative off Ethereum's market cap. So the whole thing kind of moved up in sync. And the reason why Bitcoin moved up so much is that as the Fed kept printing more and more money, you had fans of Bitcoin saying, look, the Fed is debasing the US dollar. We're going to need an alternative currency. That was a powerful narrative that the Fed seemed to be vindicating. And there was a positive feedback loop, which is the more the Fed debased the currency, the more that the price of Bitcoin went up. Now, the reason the price went up was not because they were debasing the currency. It was because they were creating so much liquidity that it created a liquidity effect that then drove up the price. And so
consumers had money that they could buy Bitcoin because there was more money in the system.
Yeah,
so you created more buyers of Bitcoin.
That's exactly what happened. All of this idiotic narrative. Sorry, go ahead, Sachs.
Yeah, you saw an increase in speculative investments across the board, including but not limited to crypto. So again, when the Fed prints too much money, it creates asset bubbles. But there's a powerful reinforcement because as the Fed was printing, Bitcoin and supporters of Bitcoin had a really great explanation for why Bitcoin was going up, which is they're destroying the US dollar. We're going to need an alternative soon. Now, I think in the very, very long term, could Bitcoin be a non-fiat currency? Yes. I actually think the technology works. You could create a new kind of currency that's backed by math and by cryptography as opposed to fiat government. But that could take a really long time. That could be decades in the future. But what happened is the market started thinking, well, that's going to happen soon. And that's where it just got ahead of itself. That was the tulip part of it.
Yeah, I think that they found all of these words, written in these economic textbooks that allowed them, frankly, to justify what a lot of people were doing in a lot of other markets, which is just straight up speculation because the money printer was going burr. And, if you look at this 92% correlation to the equity markets, I suspect in Bitcoin and crypto is probably closer to even 100%. Because it really was the furthest out on the risk curve. And it just made the most sense when you thought money was, effectively infinitely going to be available to just buy the riskiest risk assets.
Think about the friction taken out of this, Chamath. You could buy these, cryptocurrencies so easily. You could trade them so easily. You could create one so easily. People were popping up forks of these things. So in a way, what technology has done over the last 30 or 40 years, from cloud computing to software to open source, has made it very easy to pop up a startup. Well, you could pop up a currency and then you could get an incredible reward. And you get this incredible reward before you actually make a product for consumers.
And absolutely zero rules and oversight.
No oversight, yeah.
The feature that was touted was actually the first one to get thrown away, which was transparency.
Yeah.
When all of this activity was actually happening off chain, this is why you have this systemic risk issue now. When Sam is saying some of these exchanges are actually insolvent, what he's saying is, well, that exchange has one master wallet address. Every time you open an account and transact on such exchange, you're actually just transferring between a database entry inside of that company. And so it may look like it is fine, but it is actually not fine. That's what he's claiming. This is the problem with all of this. So all of this activity, built on these principles of openness and, defensibility and, you can't inflate it and, devalue it and debase it, turned out to not even matter because the fundamental principle that would allow us to verify all of that was violated right from the get-go, which was transparency. All of it is happening in the dark. Most of this stuff is happening off chain. And if you think that, it's okay to torch $1 trillion of equities, well, at least there's rules on the equity side. But to torch $2.5 trillion in crypto where there are no rules, it'll be really, it'll be a very telling sign to see if these folks get their act together, meaning regulators and politicians, and do something.
Well, then we made this crazy hybrid where we had the venture community, and I'm not going to talk about any specific firm here. And to be clear, nobody knows exactly what's happening, but you had coins.
You can't know, by the way, you can't know because it was happening off chain.
Exactly. So somebody would originate a coin and I was, offered these deals, and you would, as a venture capitalist, be buying some equity in a company, and then some amount of tokens would be created. Before the token was released to the public or before anybody had insights into this, these tokens were swapping around. Everybody had different rights. Some people could sell early. Some people could never sell. And it was as if, you took the process of going public and you gave that to a seed stage or a Series A company before they launched their product. So you're taking a company public essentially before they go.
But if you subpoena the exchanges,
they launch their product.
If you subpoena the exchanges, all of this gets turned over.
Yeah.
Because the exchanges are the honeypot of off-chain activity.
Yeah. So and that's what's going to happen, I think, in all of this. And it's going to be really funky. And what's terrible about this is why the accreditation laws exist, is like, only sophisticated people, top 6% of Americans, are allowed to participate in private companies. And what did we do? We allowed 100% of people on the globe to participate.
Backed by pure math, that less than 1,000 people in the world actually understand. That makes
what could
no
go
sense.
wrong? What could go wrong?
You cannot buy a stock, but you can buy this cryptographically secure.
Yeah. You're not allowed to buy a share of LinkedIn or Uber or Airbnb, even though you stayed in an Airbnb. You're an Airbnb host. You're too stupid to buy Airbnb shares when it's private. But you can buy this cryptocurrency that doesn't even have a product in market.
No, and here's this white paper that has, university level pure math as the explanation of why nothing can go wrong. And it turns out it can, because nobody actually understood in the first place.
This is going to be a decade of discovery.
Jason, if you look at that price chart, what it really means is, like, again, we talked about this. If the equity markets have to rebase and get all this QE out of it, right? And then you have to rebase for earnings if you believe you're in a recession, and then you have to rebase for margins if you believe that there's rampant inflation. Those three things have to happen in the equity markets. We're in the midst of that.
Yeah.
But that also has to happen in the crypto markets. And if you look at that chart, what it really tells you is that the baseline price of Bitcoin, where things seemed, where rational supply and demand were meeting each other, before all these,
10,000,
3,500 to 5,000.
Yeah, I would say about 5,000.
That's still 75% from here.